When headlines say 200 U.S. Marines are moving into the Middle East, most people think in purely military terms: ships, missiles, and red lines. But in the Strait of Hormuz, disruption often starts somewhere less visible: war risk insurance. If insurers decide the Gulf is suddenly too risky, premiums spike. Some tankers delay. Freight costs jump. And energy markets can tighten before a single barrel is physically blocked. Today, we're looking at the hidden pressure point at Hormuz, the insurance layer that can turn rising tensions into real economic effects. Fast. The Strait of Hormuz is not just a geographic bottleneck, it's a strategic choke point in the global energy system. It connects major Gulf producers to global markets, and it concentrates shipping traffic into a narrow corridor where perception of risk can change behavior quickly. That's why Hormuz sits at the intersection of regional escalation and global economic exposure. Even limited incidents, harassment at sea, drone overflights, mines, missile tests, can ripple outward through prices, freight, and investor expectations. And this is where the story gets interesting. In real-world shipping, what matters is not only can a ship pass, but can a ship pass with acceptable risk and cost? What 200 Marines actually signals? So, what does a deployment of roughly 200 Marines mean in operational terms? A Marine Expeditionary Unit, often discussed in connection with amphibious ships, signals readiness and flexibility. Not necessarily an invasion plan. More often, it's about force posture, the ability to respond quickly to multiple contingencies. Those contingencies can include reinforcing deterrence through visible presence, enabling rapid crisis response, supporting maritime security missions, and, if needed, protecting key facilities or evacuating civilians. In strategic language, it's a move that shapes the balance of risk, and it tells both partners and adversaries that the U.S. is prepared to manage escalation while keeping options open. But here's the key. Military posture doesn't just affect battlefield calculations. It can also affect market calculations, especially insurance. War risk insurance. Explained, let's break down the core mechanism. War risk insurance. Commercial ships typically rely on multiple layers of coverage. Without getting lost in jargon, the idea is simple. Insurers and underwriters price the probability and cost of extreme events, like attacks, mines, or seizures, on specific routes. When tensions rise, insurers can raise war risk premiums for transiting particular waters. They can also tighten conditions: higher deductibles, new exclusions, additional reporting requirements, or limited windows of coverage. Why does that matter? Because for many operators, insurance is not optional. It affects financing, compliance, and whether charterers, companies that hire ships, will accept the risk. So even without a formal closure of Hormuz, the route can become functionally constrained if the insurance cost spikes enough, or if coverage becomes uncertain, and war risk premiums can move quickly. Not on the timescale of months, sometimes on the timescale of days. On-screen text. Insurance doesn't need a blockade to create a bottleneck. B-roll. Underwriting papers. Premium numbers animating upward. Tanker charter contracts. Port operations. The hidden pressure point. Behavior change. Here's how insurance becomes a strategic pressure point. When premiums jump, shipping behavior can change in at least 4 ways. First, delays. Some ships wait for clearer conditions, a convoy environment, or a lower premium window. Second, rerouting, where possible, though alternatives are limited in a choke point. Third, higher freight rates, as operators pass risk costs down the chain. And fourth, a more subtle effect: market psychology. Energy markets don't wait for a worst-case scenario to price risk. they price expectations. If traders believe shipments could be disrupted or become materially more expensive, prices can respond immediately. So the insurance market becomes a kind of early warning system, translating security risk into economic pressure. In other words, the first shock might not be a ship hit by a missile. It might be a spreadsheet, premium quotes rising, contracts rewritten, shipments delayed, deterrence under stress. How military moves affect insurance. Now, where do the 2,200 Marines fit into this? In theory, increased military presence can lower perceived risk by improving surveillance, response time, and the credibility of protection for commercial traffic. That can stabilize markets if insurers believe the probability of a catastrophic incident is decreasing. But there's a paradox. The same deployment can also be interpreted as evidence that leadership expects danger. If the market reads the posture shift as a sign that escalation is plausible, premiums may rise, even if the deployment is defensive. This is a classic deterrence under stress problem. Actions meant to prevent conflict can also validate fears that conflict is approaching, so the insurance layer becomes a barometer of strategic interpretation. Not just what is happening, but what do serious actors think might happen next? 3 scenarios to watch. To keep this grounded, let's map 3 plausible scenarios and what the insurance market might do in each. Scenario A. Managed tension, military presence increases, rhetoric stays hot, but incidents remain limited. In this case, war risk premiums may rise modestly and then stabilize. Shipping continues, but at a higher baseline cost. What to watch? Fewer reported incidents, consistent naval patrolling, and insurance pricing that levels off. Scenario B. Gray zone, pressure. Here, you see harassment, drone activity, cyber disruption, or ambiguous incidents, short of a major attack. The effect is volatility. Premiums jump, then ease, then jump again. Some operators delay transits or demand higher freight. What to watch? Unexplained explosions, limpet mine allegations, GPS interference reports, sporadic tanker slowdowns, and freight spikes. Scenario C. High-impact event. A tanker is hit, a terminal is damaged, or a serious mining incident occurs. That can trigger a sharp repricing. Insurers restrict coverage, premiums surge, and shipping behavior shifts immediately. What to watch? Emergency maritime advisories, sudden freight dislocations, and public statements from major shipping firms changing transit policies. Across all 3 scenarios, the common thread is this. The insurance market transmits security risk into economic reality faster than most people expect. What have we understood so far? The Strait of Hormuz doesn't need to be physically closed to create global pressure. It only needs to become too risky to insure cheaply and consistently. That's why a deployment of 2,200 Marines is not only about ships and deterrence, it's also about confidence. Confidence among shippers, insurers, and markets that the corridor remains viable. In a modern security environment, escalation is measured not only in missiles launched, but in premiums quoted, cargoes delayed, and risk appetites shrinking. That's the hidden pressure point at Hormuz. If you want, in the next episode we can break down what maritime protection actually looks like in practice. Rules of engagement, convoy logic, and why chokepoint security is harder than it sounds. If this analysis helped, consider subscribing and tell me in the comments. Do you think markets react more to capability or to signals?